Somewhere right now, a chip maker signs a check for billions of dollars and hands it to an artificial intelligence lab. The lab takes almost all of that money and spends it buying chips from the very same company that just funded it. On paper, both sides are thriving. Revenue climbs, valuations soar, headlines call it the future, and a huge slice of the market, including retirement money you may never think about, is quietly riding on the belief that this loop never breaks. But here's the part that should unsettle you. Nobody in that chain has to be lying for the whole thing to be a bubble. The technology can be real, world-changing, permanent, and the money stacked around it can still be built to collapse. So let's do something the headlines won't. We're not going to guess a date. We're going to follow the money and find out exactly who is standing underneath it when it comes down. Start with the size of the bet. Over the last few years, the biggest players in technology have been pouring money into artificial intelligence at a scale that is hard to hold in your head. Hundreds of billions of dollars a year, flowing into data centers the size of small towns, into land, into power plants, into an ocean of specialized chips. It is one of the fastest build-outs of physical infrastructure in modern economic history. Whole regions are being rewired to feed it. Utilities are warning they can't add power fast enough. And here is the first crack. That spending is running far, far ahead of the money artificial intelligence actually brings in. The picks and shovels are being bought by the trainload. The gold they're supposed to dig up is still mostly a promise. When you build a factory, you expect it to pay for itself with what it produces. These machines are being built faster than anyone can prove they'll pay off, and the gap between the two numbers is measured in the hundreds of billions. Now watch how the money moves, because this is where it gets strange. A leading chip maker invests billions in an AI lab. That lab turns around and spends the money on chips from that same maker. A giant cloud provider strikes a deal to host another lab's models, and in the same breath invests in it, while that lab commits to spending on the cloud provider's servers. Round and round it goes. Each deal is announced as growth. Each one lands as revenue on somebody's books. But step back and look at the shape of it, and you'll notice something uncomfortable. A lot of this money never really leaves the room. It's the same billions, circling between a handful of companies, counted as a win every time it passes a new set of hands. Real demand from the outside world, actual customers paying for actual results, is supposed to be what fills that room. And right now, a surprising amount of the money inside it was put there by the players themselves. There's nothing illegal about any of this. Companies invest in their own ecosystems all the time. But when the same dollars keep reappearing under new names, the growth on the screen can look far bigger than the demand underneath it. And a market that mistakes circulating money for new money is a market pricing in a future that hasn't actually shown up yet. So does the technology work? Yes, and that's exactly what makes this so tricky. Because working in a demo is not the same as paying off in a business. One widely cited study looked at a large sample of corporate pilots of generative AI, companies actually trying to plug it into real operations. The finding was brutal. The overwhelming majority showed no measurable financial return. Not a loss, in most cases, just nothing you could point to on a balance sheet. The tools were impressive. The chatbots were fluent. The demos dazzled the boardroom. And then the quarter closed, and the numbers hadn't moved. Now, that doesn't mean the value will never arrive. New technologies often take years to translate into profit. But every dollar of that trillion-dollar build-out is being spent today on the assumption that the return is coming soon. And soon is doing an enormous amount of work in that sentence. There's an old line from a gold rush. The people who reliably got rich weren't the miners. They were the ones selling picks and shovels. That's roughly the shape of this moment. The companies selling chips and building data centers are making real money right now, today, in cold hard cash. That part is not a mirage. The mirage is one layer up. It's the assumption that the miners, the companies actually building products on top of all this, will eventually strike enough gold to justify what everyone paid for the tools. If that application revenue shows up, the whole structure holds, and this looks like the smartest infrastructure bet in a generation. If it doesn't, If the gold stays thin while the shovel bill keeps climbing, then the spending stops. And when the spending stops, the picks and shovels business, the one everyone called a sure thing, is suddenly selling to customers who've gone quiet. Here's why this isn't just a story about a few tech giants. A small number of enormous companies now make up a startling share of the major stock indexes, the very indexes sitting inside pension funds, index funds, and ordinary retirement accounts. When you own a slice of the market, you probably own a heavy slice of exactly these companies, whether you chose them or not. That's the quiet part. The AI bet isn't cordoned off in some risky corner where only gamblers play. It's been woven into the safe, boring, set it and forget it center of how normal people save for the future. So if these valuations are running on optimism that doesn't pay off, the correction wouldn't stay politely contained. It would ripple out through the funds that millions of people are counting on to still be there in 30 years. The exposure was never opt-in. For most people, it's simply already there, baked into the default, humming along quietly until the day it doesn't. None of this is new, and that should be the most sobering part. Wind back to the year 2000. The internet was real. It was going to change everything. And it did. But that truth didn't save the market from the dot-com crash, because being right about the technology and being right about the price are two completely different things. Fortunes vanished into companies that had the future correct and the business model wrong. Go back further to the railway mania of the 1800s. Trains genuinely transformed the world. And investors still lost everything betting on rail lines that were never going to earn their cost. The pattern rhymes across centuries. A real revolution arrives. Money floods in faster than reality can absorb. And the technology survives, thrives, reshapes the world, while a whole layer of the people who financed it gets wiped out on the way there. So let's be honest, because the honest answer is the least comfortable one. This is not everything crashes tomorrow. Nobody watching this, not me, not the loudest voice in your feed, can tell you the date, and anyone who claims to is selling something. But it is also not, there's nothing to see here. The mechanism is real. The spending is running ahead of the returns. The money is moving in circles that flatter everyone's numbers. The risk is concentrated in the exact place ordinary people are told is safe. History is full of moments where the technology was genuine and the valuations were a trap, at the very same time. Both things can be true. The right response isn't panic, and it isn't blind faith. It's clear eyes, an honest look at who is exposed, and a sober understanding of why. So here's the question I'll leave you with. If the AI revolution is completely real, and the bubble around it is also completely real, which one do you think reaches your life first, and are you ready for it? Tell me in the comments.